It's not too late. And before this video is over, I'm going to prove that to you with math, not motivation. This is not a pep talk. It is a strategy session specifically for W2 employees in their 40s and 50s who have been watching real estate content for months, maybe years, and keep telling themselves the window has closed. It has not. But the strategy is different from what works at 25. And almost nobody in this space ever says that out loud. I am saying it today. Start with the belief that kills more late starters than any financial obstacle does. The belief goes like this: I do not have enough time for compounding to work. Wrong. Completely wrong. And here is the specific reason why. Real estate does not need 30 years to produce meaningful results. A 45-year-old who buys one solid rental property in Indianapolis today and holds it to age 55 gets 10 full years of 4 simultaneous wealth-building mechanisms: cash flow, tenant-funded mortgage paydown, appreciation, and depreciation tax shelter, all 4 running at once for a decade. That is not a consolation prize. Most people in their 50s never build that position through any vehicle. Now the honest part, because reassurance without honesty is useless. Your margin for expensive mistakes is narrower than it was at 25. A younger investor can buy a money pit, absorb the loss, and have 15 years to recover before retirement. At 48, that same mistake costs you differently. Not because real estate is riskier for you, because your recovery timeline is compressed. The adjustment is not to avoid investing. The adjustment is to invest with more precision. One high probability strategy executed well beats 4 experimental strategies running simultaneously. For most late starters with stable W2 income and 10 to 15 years of runway, the highest probability strategy is simple: 2 to 3 cash-flowing properties in durable Midwest markets, held and managed professionally, with mortgages being paid down by tenants every single month. What most people in this demographic miss is the structural lending advantage they are sitting on. 20 years of W2 employment history, a credit score built over decades of on-time payments, home equity, savings, a debt-to-income profile that makes lenders genuinely enthusiastic. A 25-year-old investor is often fighting uphill on financing. You are not. Your W2 is the cleanest lending profile that exists in the conventional mortgage market. Better rates, easier qualification, stronger negotiating position at the table. The thing you have been treating as a limitation is actually the asset that opens doors closed to a lot of the people you are watching on YouTube. Target 2 to 3 properties, not 10. Not a sprawling portfolio. 2 free and clear rentals at 60, generating $1,600 each in rent. Produce $3,200 per month with 0 mortgage payment. That number changes retirement math permanently. The late starter's real play is not maximum acquisition speed, it is strategic paydown. A 10 to 15-year hold gets you close to free and clear on properties bought today, either through normal amortization or by directing accumulated cash flow toward additional principal payments. Market selection matters more for you than for a 30-year-old. You want operational stability, not growth speculation. Indianapolis, Columbus, Cincinnati, Kansas City. These are not exciting markets. That is the point. Low vacancy rates, reliable rent growth, professional property management infrastructure, landlord-friendly legal environments. You do not have time to recover from a speculative bet in a volatile market that turns against you. Stability is not settling. For your time horizon and risk profile, it is the correct analytical choice. One financing decision to make consciously. A 45-year-old on a 30-year mortgage does not pay that loan off until 75. Relevant. 2 options. First, consider a 15-year mortgage on at least 1 property. If the cash flow still pencils. On a $135,000 loan at 6.5%, the 15-year payment is approximately $1,178 versus $854 on a 30-year, $324 more per month. Loan gone in 15 years instead of 30. Second option, stay on 30-year loans, but make additional principal payments monthly using accumulated cash flow. Even $200 extra per month compresses the timeline meaningfully and builds equity faster than the amortization schedule alone. Let me run a concrete scenario. You start at 45. Year 1, you buy in Indianapolis. 180,000, 25% down, 6.5% rate. Net monthly cash flow after the full expense stack, approximately $150. Not life-changing. Not the point. Year 2 or 3, you buy a second property using accumulated savings. 2 properties now, combined net cash flow around $300 per month. Then you hold. Rents in Indianapolis increase 2 to 3% annually. By year 10, each property is collecting $1,700 to $1,800 in rent against a fixed mortgage payment of $854. Net cash flow per property has grown to somewhere between $350 and $450 per month. 2 properties combined, $700 to $900 monthly in net income, growing. Each loan has been paid down $25,000 to $30,000 in principal by your tenants. Combined equity across the portfolio, including modest appreciation, $250,000 to $300,000. At 55, you have choices you do not have today. Sell one property and use the proceeds to pay off the mortgage on the other entirely, suddenly collecting $1,600 to $1,800 per month in rent with zero debt service. Or hold both, let the cash flow keep growing, keep the mortgages amortizing. Or refinance and pull equity to fund a third acquisition. None of these are theoretical paths. They are the actual decision set that shows up for someone who bought 2 solid properties at 45 and held them without panicking. The psychological obstacle I want to name directly, because it is the one that actually stops people. The comparison. Someone on YouTube has 8 units and they started at 28. You are 46 with 0. The comparison feels paralyzing. It is also completely irrelevant. That investor is not your benchmark. Your benchmark is the version of yourself that does nothing for the next decade and arrives at 65 with a $401,000 distributing $3,500 per month and no other assets. Against that outcome, 2 paid-down rental properties generating $4,000 to $5,000 monthly in gross income is not a runner-up result. It is a dramatically better position than most people in your cohort will ever reach. You are not behind, you are starting. Those are different things. Starting is something you can act on today. One thing before I close, and this is the part most people skip because it feels like a detail. Before you buy anything, interview 2 property management companies in your target market, not after you're under contract. Before, ask them, what is your average vacancy rate across your current portfolio? How do you screen tenants? And what is your eviction rate in the last 12 months? What is your fee structure and are there charges beyond the monthly percentage? Can you give me 2 current landlord-client references I can call this week? The company that answers those questions with specificity and produces references quickly is the one you hire. The one that gets vague on their fees or cannot produce references is the one you cross off the list. That conversation takes one Saturday morning. It determines whether your investment runs smoothly or becomes a management problem that consumes your evenings for years. Late starters especially cannot afford the latter. Build the team before you need it. Every other part of the acquisition process is more forgiving than this one. And a word on the 401,000 question, because it comes up constantly in the comments on videos like this. Should I pull from my 401,000 to fund a down payment? The short answer, probably not, and definitely not without talking to a CPA first. Early withdrawal penalties and the tax hit on a traditional 401,000 distribution can cost you 25 to 35% of whatever you pull out before it even reaches your bank account. That is an expensive source of capital. What is worth exploring with your CPA is a self-directed IRA structure that allows real estate investment within a retirement account or a 401,000 loan if your plan permits it, which avoids the penalty and tax treatment of a full withdrawal. These are real options. They are also genuinely complex and highly dependent on your specific plan and tax situation. Get professional guidance before you touch retirement accounts for this purpose. The point is that the down payment capital does not have to come exclusively from current savings, but the path to accessing other capital sources has to be navigated carefully. In the next video, I am finally delivering the house hacking breakdown that has been promised across this entire series. How to buy a small multifamily, live in one unit, eliminate your housing payment completely, and redirect your full salary into building exactly the kind of portfolio we modeled today. Subscribe so you do not miss it. Drop a comment with your age and one specific obstacle that is currently keeping you from your first offer. I read every comment and will respond with a direct, honest take on your actual situation. See you in the next one.